retail's been a very stressed. When you think about distressed assets, the word retail usually rises on the screen. What's interesting about the stocks you mentioned is we tend to chase sort of the shiny new brands, in part because of where we are in the innovation cycle. The three you've mentioned are not stalwarts by any means, but they certainly do have a long track.
I would call Intel a stalwart.
So is that a theme? Again, I don't want
Yes, it is. Like back to your example of General Electric. It looked like a stalwart. It had 120 years of history, but a few bad decisions over, a lot of bad decisions over a couple of decades will take its toll on any company. So there's always that management risk, but Intel, it's executed for 5 decades, going into its 6th decade now. But in 2022, dividend-paying stocks, if you bought an ETF like the DVY, there's one called the NOBL, which tracks the dividend aristocrats. The dividend aristocrats are companies that have paid dividends consistently for 25 years that have never decreased, never been suspended. So
we love aristocrats. So
aristocrats, exactly. You can drink your tea and stick your pinky finger out and dive into that. There's dividend growth. Let me just. This is a very important concept. So you buy a stock like Intel, and you're getting that 5.5% dividend yield. But what happens over time? They're hiking the dividend higher and higher and higher. So let's say you throw $10,000 in there, so that 5.5% yield the first year, you're getting $550. But then they keep raising it 10% a year. So your yield on your original cost 10, 20 years down the road will be astronomical. Qualcomm started paying dividends in 2003, and over the last 2 decades, it's grown to the moon. So your original yield, if you bought Qualcomm in 2003, was something like 1.6%. But because of the dividend hikes, you're way up over 13%. So I believe that if you choose good stocks with a long history of doing the right thing in terms of being in the right business, managing it right, never forgetting that dividend, because you cut the dividend, you tick off a lot of people.
There have been a number of companies that have cut the dividend because of tough times. So that's a warning flag for you?
It is, unless it's like a hurricane strike. 2 years ago, when COVID hit, it was probably the smart thing to do to conserve cash. Nobody knew what was going to be going on. All the restaurants, Cheesecake Factory, Bloomin' Brands, Ruth Chris, by the way, RUTH, Ruth Hospitality Group, fine steaks at Ruth Chris, as you know. And
Cheesecake Factory around here, by the way, in Jersey City. So
exactly. Cheesecake Factory cut their dividend. But a lot of them put it back into place, and even Ethan Allen, Interiors, the furniture company, suspended the dividend after COVID, but after a few quarters they resumed it, and they paid back what they should have paid, so they had a special dividend.
So, John, before we move on from dividends, we've got retail investors and obviously sophisticated institutional investors. We'll leave them to their own devices.
Sure.
The common advice typically for retail investors is to buy an ETF or to basically hedge your bet so that you're not doing individual stock picking. Is this a time where individual stock picking actually makes more sense than it has in previous years?
Well, if you follow a guy like me, it's very smart to pick individual stocks. But no.
True.
This is true. I'm not going to brag, but we do have the data going.
Yeah.
Over the past 10 years, we have outperformed the S&P 500 and about 26 of the 30 dividend ETFs that we track.